All right, chapter 5. Chapter 5 is a continuation of inventory costing. And I will, at the end of this video, it's probably the most important part to watch of the video is the ending, because the ending will set up the rest of the different lectures. But we're going to continue with this idea that we're going to cost our inventory. Sorry. There are a number of learning objectives. So I'm going to walk us through identifying the items and cost of merchandise inventory. I'm going to do that in this lecture. And then some of the latter lectures, I will discuss some of the analytics of the chapter. I'll save that to the end. But the vast majority of lecture videos that we're going to post for chapter 5 are going to have to do with these inventory costing methods that we're going to refer to as FIFO, LIFO, specific, and weighted average. And again, it's going to make more sense, I think, towards the end of this lecture. And then we're going to talk about something that's called the lower of cost or market. And I think that'll just make it's actually a fairly straightforward concept. Nothing too dramatic. Okay, so in this chapter, as it relates to inventory, so we're really trying to figure out what's the true cost of the inventory that we've acquired from a vendor, and then what is the cost of that inventory that we're going to pass off to the consumer. Seems like it would be pretty easy, but there is a lot of complexities that are on the horizon. Okay, so in this chapter, we're really going to talk about various types of things that we would include in our inventory, right? So anything that's in transit. So if it's on the way, if we own it and it's on the way, then we're going to include that in our cost of inventory. Goods on consignment, right? So we could have inventory that we choose to sell at somebody else's place of business. So we could, I don't know what the example would be, but we could take inventory to a flea market and try to sell it at the flea market. So if we just give it to the flea market and we say, hey, we're selling skateboards, please try to sell these skateboards for $50 a piece. All the skateboards that are at the flea market, that is our inventory, right? That's what we mean by allowing somebody else to sell goods on consignment. And then goods damaged or obsolete, so we're clearly not going to include those. So if we can't resell it, we don't want to include it in the cost of our inventory, right? So a couple of terms I want to say that we've covered previously, but just to reemphasize, freight on board, so FOB, freight on board, that means that actually freight on board shipping point means that we own the goods as the minute it leaves the vendor's destination. And then FOB destination is that we don't really own or take ownership of the goods until they land on our doorstep. Not terribly complicated. Goods on consignment, I think we just talked about that in enough detail. And then damaged or obsolete. Again, we're not going to include these in our cost of inventory, or when we are quantifying our inventory, we're not going to include these items. And then determining inventory costs. This is, again, a bit of review, right? So we're going to include shipping, the cost of shipping, the cost of storage, the cost of insurance, and then any import duties. Some of those are new. Internal controls, I'm not really going to go through this, right? But there are ways for us to instill a set of procedures within our firm that would reduce the likelihood of employees or customers stealing our inventory, right? So if you go into a Walgreens or any type of pharmacy, a lot of these companies, even if you go to Home Depot these days, a lot of these companies will have their inventory literally locked up And that is a form of internal control, right? We're preventing consumers from coming into our place of business and outright stealing from us. That's an extreme example. There are less extreme examples. I will let you uncover the mysteries of those on your own. Okay? This schedule, or sorry, this PowerPoint slide really is the kickoff point for the rest of the chapter. Okay? So we're going to quantify the cost of our inventory and then assign costs to goods that we are selling based on four methods: specific identification, first in, first out, last in, first out, and weighted average. And for the most part, that stuff sounds like a little confusing. So for me, I'm going to use my trusty, everybody else would call it a chalkboard. I'm going to call it my scribbling board. Uh, and I'm going to do my best, but chances are I'm going to draw something hideous. Okay, so we have inventory. What are we selling? I don't know what we could sell. Like, I'm a huge foodie. Like, I'm always thinking about food. If that's not obvious already, you definitely were not paying attention to my videos. I'm always hungry. I'm hungry now. I had a steak sandwich. I had two actually, and that was probably 2 hours ago. And I'm clearly dreaming about dinner. So anyway, starving. Let's talk about avocados. Like, are you a guacamole fan? I'm a huge guacamole fan. Spicier the better. Okay, so avocados. Look, maybe they're currently $3 an avocado, right? Currently, like today, or maybe I will say 3 days ago, they were $3, right? 3 days ago, they were $3. 2 days ago, they were $4. And I'm just making stuff up. 1 day ago, yesterday, they were $5. And then today, man, crazy enough as it seems, maybe they're not, but maybe we could say today they were $6. Okay. And let's say that 3 days ago, I purchased 15 avocados at $3 a piece. So the journal entry, I think, would be, let's assume that I paid cash. I would say inventory, right? And if I purchased 15 avocados and paid $3 a piece, I can do that in my head, crazy enough. $15 cash, $15. 2 days ago, purchased, let's say that we purchased 10 avocados at $4 a piece. I think I would have inventory 40 and cash 40. Okay. 1 day ago, let's say I bought 20 avocados at $5 a piece. Inventory 100, cash. God help me, 100. God help me if 5 times 20 isn't 100. If it's not 100, I literally am gonna retire after this lecture. Hopefully I got it right. And then finally, let's say we bought one avocado. We bought one avocado yesterday for $6. Inventory $6, cash $6. Actually, I guess that was today. Okay, so today, end of the day, customer comes into our store, grabs an avocado, right? So every time I purchase the avocados over the last 3 days, I just grabbed all the avocados that I purchased on the first day. I grabbed, I purchased 5 on the first day. I think I said I purchased 10 on the second day. Then I think I purchased 20 on the yesterday. And then I purchased 1 yesterday or today. Sorry, man, killing myself. So I have a total of 36 avocados and they're all on the shelf and they're all mixed up. And I literally have no idea which avocado was the one that I purchased 3 days ago for $5 a piece. Sorry, for $3 a piece. Which avocado was the one that I purchased yesterday for $5 a piece? Like they're all mixed together. But a customer comes in and wants to buy an avocado. And so the question is, man, how much does the avocado cost? Right? So if a customer comes in, let's say that I have, boom, I cleaned it up, right? For the sake of our discussion. But it's the same concept. 3 days ago, I purchased 5 avocados for $3 a piece for a total cost of 15. 2 days ago, I bought 10 avocados for $4 for a total cost of 40, etc., etc. So today, right? Today, a customer comes in, buys an avocado, right? Grabs an avocado off the shelf. When I'm using a perpetual inventory system, I have to do 2 journal entries. The first journal entry is to record revenue. Let's say I'm like some high-end niche grocery store and I'm fucking selling avocados for $10 a piece, right? It's just out of control crazy. Don't know if there's any stores like that in LA, but there are some stores like that in the Bay Area, and I would never go to them. Okay? But so I sell an avocado for $10. The first journal entry is to record revenue. So cash customers only in our store, $10. And then revenue, $10. Okay? That is, sorry, that is to record revenue. And now the question is, the second journal entry that I have to make when I do a perpetual inventory system is cost of goods sold and inventory. So I am going to debit cost of goods sold. We learned that last chapter. And then I would credit my inventory account. And again, the question is, what's the value of cost of goods sold? What avocado did the customer grab off the shelf? We really don't know. Like the assumption is like every single avocado looks exactly the same, right? To me, that there are some avocados that look a little bit different, but for the most part, they basically all look the same. Okay? And so I don't really know what avocado this customer purchased. And so instead of using a specific cost, what I'm going to do is I'm going to assign a cost to the avocado based on one of 3 methodologies. Those 3 methodologies are, first will be, in fact, I'm not going to do it that. I'm going to go right here. I will go with LIFO. And LIFO is the last avocado to come in, would be the first avocado to go out, right? Again, it's not the physical avocado, it's just the cost of the avocado. I literally have no idea what avocado came in. The second one is going to be FIFO. FIFO. And FIFO, right? Every time I hear FIFO, I always think of the Seven Dwarves. FIFO. I can't even believe I just did that. FIFO. Right? To me, it's always like, sounds like the little dwarves that sing that song in Snow White. Off to work we go. Hi ho, hi ho. FIFO, FIFO. Ha ha. Anyway, FIFO. First in, first out. Okay, so the first avocados that came in, those were the avocados that cost $3 a piece. They came in 3 days ago. So I would assign the $3 cost to the avocado that I just sold, recognizing that I have no fucking idea which of the four different types of avocados I have to choose from. Sorry for the language. Finally, you guys should know that in my face-to-face classes, I swear all the time, right? I personally think it's just a nice way to relate to you guys. At the end of the day, I'm nothing more than a community college student. I'm just way older and I went to school a long time ago. But underneath everything, for me, I am still just a community college student. And when I was in community college, I swore a lot. And when I'm in community college now, I still swear a lot. Anyway, LIFO, FIFO, the third one is weighted average, meaning we're going to take the weighted average of all of those avocados. And I will show you how to do all three of those methods in the upcoming um, lectures. But for the most part, if I was choosing LIFO, it's last in, first out, the last avocado to come in cost $6, right? It was way down here at the bottom. The last one to come in was the ones that came in today. So I would use $6 if I were using last in, first out. And then if I were to sell another avocado, I would grab it from this bucket, right? One day ago. That's the next oldest avocado. Then if I was using FIFO, first in, first out, I'm going to pull from this bucket, right? So the avocado that I just sold, again, I don't know which one it was, but I'm just going to assign a cost of $3 because that was the first cost to come in, and therefore it will be the first cost that I assign on the way out. And then if I was using weighted average, I will go through weighted average again in the detail, but I would total up all of the costs, total costs, and to me that looks like it's going to be 15, 55, 155, 161. That's the total cost. And then I would divide it by the total quantity, which is 36. And you guessed it, I can't do that in my head. So I'm going to do 161 divided by 36. Give me a second. 161 divided by 36, I'm getting $4.47. That would be the weighted average. And it would make sense that the weighted average was somewhere close to the $5 cost because we purchased 20 of those avocados at $5. That's the heaviest weight. And so the weighted average would be $4.44. So it would be $4.44. Okay. There's a lot of complexity, not a lot of complexity, but there are things that I do feel like I want to um, address in the specific examples as we move forward. But this is the three methods that we would use when we are trying to quantify the cost of inventory when the products are homogeneous. Okay? If you remember the PowerPoint slide, there were four methods. Okay? There were four methods in the PowerPoint slides. The four methods in the PowerPoint slides, the first one is specific identification, and that wouldn't be a good one to use when I'm selling avocados. Okay. I would use specific, let me back up. I would use FIFO, LIFO, and weighted average when I'm selling a homogeneous product like avocados. I would use the specific method when I'm selling products that are totally unique and I don't sell a lot of them, right? So if I was a real estate agent and I was selling a property in San Jose up here in Northern California, as opposed to, Malibu Beach down there in Southern California, and I don't know, maybe Malibu Beach is a bad example. I don't know what beach is close to you guys. I'm a beach person. I love beaches. In fact, I don't even know why I picked San Jose because there's no fucking beach in San Jose. So Santa Cruz up here, and then let's go with Avila Beach probably is still too north of you guys, but Avila Beach was a favorite beach of mine when I was in community college. I would go party there all the time with a friend that went to school down there. Anyway, so if I sold a house in Santa Cruz, okay, if I let's just say that I purchased the house first in Santa Cruz, I purchased, oh, I can't use maybe okay, so I'm getting so good at this, it's not even funny. But let's say that I buy the house in Santa now, oh, it is working. Okay. I buy the house in Santa Cruz and I pay, it's a beautiful house. It's like 7 bedrooms and I pay $4 million for that house, right? Beautiful house. And then I buy a house, where did we say? Avila Beach. I don't even know how to spell Avila. Maybe that's close. But I buy this like little fixer upper in Avila. And the house, it's like almost, it's got mold everywhere. There's only 1 bedroom. There's no roof. It's just like terrible. Let's say that I paid 700,000 for it. Okay. All right. So let's say that I purchased the Santa Cruz house first and then the Avila house second. Let's say that I sell the Avila house. I sell the Avila house for $2 million. An absurd example, but and I pay and I'm selling it for cash. It would be cash 2 mil. Revenue 2 mil. And then I have to do cost of goods sold, right? I'm not gonna go with FIFO, first in, first out. I'm not gonna say, oh, the cost of goods sold is 4 million because I'm using FIFO. That's crazy, right? It's like I know the house that I just sold. It's the house that I bought in Avila. I don't have to like assign some cost to it because I know exactly how much it cost me. It cost me 700,000, right? I've only got 2 houses. It's pretty clear to me that I could use the specific method regardless of when I purchased. I don't know where my undo button is, but anyway, I guess I'm not as good as I thought I was. Here it is. That's so cool, right? I'm going to use the specific method. The cost of goods sold for the house in Avila was 700,000 and my inventory 700,000. Okay. The rest of the videos, we're going to just walk through these examples. There again are some nuances. I want to know what the resulting ending inventory is in addition to knowing what my total cost of goods sold is. And we'll talk about that in the next videos. But anyway, this is the chapter that everybody who is destined to become an accountant, you guys fall in love with this chapter, right? So if you get through the end of this chapter and you're like, oh my God, I love this chapter, you're going to be an accountant for the rest of your life. Okay. And chances are nobody falls in love with this. Like I've been teaching this class for 10 years online, in person, and nobody falls in love with this chapter. Nobody becomes an accountant for the rest of their lives. At least none of my students. So anyway, yeah, hope you like the chapter. It's a good chapter.